Vanakkam, Namaskar, and hello to all the listeners of this edition of Fixed Income Markets with Sundaram Mutual Fund. From the last edition, when we touched base, MPC had an inter-policy unscheduled meet just hours before the Federal Reserve meet where they decided to hike the repo rate by 40 basis points, taking it to 4.4%. Consequently, they revised the floor rate, which is the standing deposit facility rate, to 4.15%, the de facto floor rate of the LAF corridor, and the ceiling rate, which is the margin standing facility rate, to 4.65%. This is the first hike in around 4 years. This was attributed to the faster rise in price pressures due to geopolitical issues and China lockdown. Nonetheless, the issue of India being connected to the global supply chains, an out of turn hike was justified. Although to mellow the hike, a accommodative stance was retained. We believe that this was long due, but the timing and quantum both were a surprise, considering the earlier series of communication from the central bank. We also suspect that the central bank is anticipating sustained price pressures breaching the tolerance band of 6% in inflation targeting mechanism. And with demand for dollar rising on account of commodity prices on the boil and sustained selling from foreign portfolio investors, they have sold to the tune of 22 billion US dollars, and the foreign reserve having depleted below 600 billion US dollars is probably prompted the RBI to make it attractive for foreign investors to put monies in India and match the pace of rate hikes which all other central banks in the global arena have embarked on. On the other hand, the Federal Reserve delivered the rate hike largely anticipated by the markets, and the post-policy conference allayed the fears of larger quantum hikes of 75 basis points not being on the table. In addition, the FOMC stuck to its winding down date of 1st June, which the market feared will be preponed to May. In our opinion, the economic parameters are largely on track considering the robust tax collections, both in volume and value terms. But with the rate hikes being forced onto India because of the global cycle, growth slowdown is a distinct possibility and can result in stagflationary situation until unless supply side issues get resolved as well as the geopolitical situation stabilizes. From a product perspective, we think we have just embarked on the rate hike cycle, and next 2 quarters can be volatile with rates bias on the higher side, which, considering the risk reward and margin of safety, an investor with very short investment horizon is better off in products like overnight, liquid, or ultra, while investors with medium term investment horizon of 18 to 24 months can distribute money in mid duration products like medium duration, banking PSU, corporate bond, and any roll down product suitable to their risk profile. Investors with very long investment horizon can also take this opportunity of rate hike cycle and distribute their monies in tranches into long products, because as a matter of fact there are two forces which act on any fixed income portfolio. One is your mark to market and the other one is your accrual. From a mark to market perspective, all fixed income portfolios in any duration buckets are facing a decrease in value, but simultaneously the accrual yield of the portfolios is rising with the rise in rates, and this is making it more attractive for longer investment horizon investors. So I think with going forward, it will become more attractive from a fixed income proposition, and investors can now earn a better yield out of the fixed income products. Another phenomena which we have observed in the past and we think it will be repeated is as the capital market rates rise, the bank and FD rates tend to lag the capital market rates. And I think this will be no different. And this will also again make the mutual fund products much more attractive because they are just a pass-through vehicle. I think that's what we have for this edition. Thanks a lot for listening.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.